Hello everyone, my name is Mark Jarvis and I'm a visiting professor at Manchester Metropolitan University. Welcome to the fourth webinar in this series, which I recorded every other Thursday, the weeks in between. There is a live meeting via Zoom, which you can join. I've got a different topic each week, and to find out what's happening next week, please email cpe@mmu.ac.uk, or keep an eye on my profile on LinkedIn, where I will post a link to register in the next day or so. So today we're going to, of course, start by an update on the virus. Then we'll move on to the bounce back and what will it take to get us the economy off and running again. We'll touch on the latest from the ECB, European Central Bank, and the Bank of England. We'll have a little look at the climate impact of the economic slowdown and how that is, how COVID-19 and the economic impacts are affecting climate change. Before moving on to the impact COVID-19 will have on poverty around the world, which is quite a distressing story. And then we'll finish on the UK and a touch on the travel sector. We always do a touch on one sector on each of these seminars, so this week we'll talk about the travel sector. So if I may, I'll share a graph to start it off. And this infographic looks at the rolling 7-day averages for new COVID-19 deaths per million people. And I think this is an interesting way of looking at things. It's, you know, we're bombarded by different statistics constantly. And I think we are all very well familiar with what's going on. But this one is the rolling 7-day average. And very interesting to see that at the top of the list, as of May 27th, which is yesterday at the time of this recording, is Sweden. Now, this Nordic country has enforced few social distancing or lockdown rules, and is now seemingly paying the price for this approach. The UK, we originally embarked on a similar strategy of aiming for herd immunity, which we moved away from, as we're all too familiar with, is also present at the top part of this ranking. And then Brazil, where President Bolsonaro has staunchly rejected social distancing and blanking lockdowns, is perhaps unsurprisingly in second place. And we can see some very worrying stories in the online media about that at the moment. According to a prominent doctor in Peru, the escalating situation there is, despite a quick implemented lockdown, is mainly down to people not respecting the law. So something there for us to think about as we begin the great unlockdown of the UK, and watch what happens in Sweden. So back to where we were talking about how we can bounce back the economy. I think it's very important to say that people have to be fully confident for the economy to rebound from the coronavirus crisis. It might take a vaccine to make that happen. Until then, barring a second wave of the virus, we should expect a slow but steady economic recovery. The COVID-19 crisis has created perhaps the highest level of uncertainty in 35 years. The longer people worry about the risks to their lives and livelihoods, the more severe the economic damage. There's really only one way out, and that is crush the uncertainty as soon as possible. And that's when confidence will return and economies will recover, in essence. The world needs to get on a near zero virus path as soon as possible. In some regions, this may, of course, be very difficult or even impossible, but the difference to global GDP that this quicker resolution could be, and it's difficult to plan, obviously, but pundits have said could be a difference of between 15 and 20 trillion dollars if we make things happen quicker rather than slower. McKinsey, who asked global executives how long they believe their economies will take to return to pre-crisis levels, ranged between 3/4 of a year and more than 5 years. And similarly, when they polled customers about when they expect their lives to return to some level of normality, answers range from months to years. And again, sharing a graph for a second, I think this is a very telling graph from McKinsey. The blue line talks about GDP growth since 1985, and the black line tracks a US economic policy index called the uncertainty index. And it's almost as though you're seeing a mirror graph. It is very clear to see that and if I look here, as uncertainty rises, so does the GDP reduce. And this is very similar all the way down. Of course, here we've got some big spikes the other way, but broadly what we're seeing here is that get rid of that uncertainty, get the people back into the economy, and things start picking up. And without that, GDP doesn't grow. So, a possible paths out of the crisis, well, there's something called the Balancing Act, which this is a goal often articulated by government leaders who have chosen this path. It's to lift lockdowns gradually while keeping the number of patients with COVID-19 within the capacity of the UK NHS. If the public health measures supporting the release of the lockdowns turn out to be sufficient to keep the virus spread at bay, this path could be effective. The virus could recur locally or regionally, as we are seeing in Sweden, as we just discussed. But after lockdown measures were recently eased in Germany, for instance, infection rates started to creep up again. And authorities are now even there discussing the risks of a second wave and even a new peak of infection. So critically, the viability of this balanced path is uncharted territory, even if a specific version of the Balancing Act path turns out to be successful. I think uncertainty and risk will remain high for an extended period. People may only feel fully confident about their safety when they see conclusive proof that this path is not called a virus reoccurrence. An assurance, realistically, that may not come until much later in 2020. So having a quick look now at the macroeconomic side, Europe and the UK. So next week, the ECB, European Central Bank, will present its latest macro projections. And this will be at the core of its next week's meeting. Needless to say, the March projections, which predicted GDP growth to come in at some 0.8%, is heavily outdated. So for the April meeting, the ECB have prepared 3 different scenarios, with real GDP for the Eurozone dropping by about 5% or 8% or 12% under the mild, medium and severe scenarios. According to recent statements by ECB President Christine Lagarde and other ECB officials, the mild scenario has become sadly highly unrealistic, and next week's forecast could somewhere be between the medium and the severe scenario. For comparison, many still expect the Eurozone economy to shrink by around 8% this year, and I think we'll see that in next week's announcement. Looking at the Bank of England, the Governor of the Bank of England, Andrew Bailey, has warned that Britain's recovery from our COVID-19 slump may be tougher than anticipated, and signaled that a fresh wave of money creation may be needed. A third of our 32 million strong workforce is now being paid by the government via staff furlough or self-employed support schemes. So Bailey made clear that the Bank of England was contemplating new moves to boost growth. He also indicated that support was more likely to come in the form of quantitative easing, where perhaps the bank buys government bonds from investors and creates money in the process, rather than by cutting official interest rates to below zero. Since COVID-19 crisis began in March, the bank has cut, as we know, the official borrowing rate to 0.1% and announced some £200 billion worth of quantitative easing to ease the financial pressure on large companies and to make it easier for banks to lend. Bailey continued to express concern, however, about going a step further with negative interest rates, and I don't think we'll see this, to be honest. But with him noting that unemployment rate had more than doubled and expressing his concern about a quick bounce back, I think the 9-strong monetary committee of the Bank of England is probably braced for stronger measures when it meets next month. Now, one of those measures, which you may have seen in the press, is something called helicopter money. So the term helicopter money has been bandied around a lot in recent weeks as a mechanism to pay for the expensive rescue packages that governments have launched in response to coronavirus. But helicopter money is actually an old concept, first mooted by famed monetarists and advisor to both Ronald Reagan and Margaret Thatcher, and that is, of course, Milton Friedman, who in 1969 invented this term, and it was popularized in 2002 by the then Fed Reserve Chairman, Ben Bernanke, who said it was a solution to Japan's lost decade of low inflation and growth. So the simplified idea in concept is a central bank prints money and drops it out of helicopters for people to pick it up and spend, generating demand, growth, and inflation. Though, of course, in reality, helicopter money takes many other more technical and complicated forms. Helicopter money is not the first best solution by any measure to pay for stimulus measures, but it could be a likely one. The chorus of voices calling for helicopter money is really picking up, but the traditional way to fund a big fiscal stimulus for governments is to borrow money by issuing debt. The conditions for debt financing couldn't be better for most major developed economies. Central banks have slashed rates, promised rates will remain low for the foreseeable future, launched a veritable alphabet soup of programs to purchase debt, sending borrowing costs plummeting. Even countries with huge debt burdens, such as Japan and Italy, can manage their debt load as long as the debt servicing costs remain negligible. But there are already signs that political support for debt financing is waning. In the US, there's been a reticence to provide what is perhaps desperately needed federal funding to the states, to individual states. For example, and in the Eurozone discussions about conditions on bailout money to limit some downside have emerged once again. So given these growing political headwinds, helicopter money, strange term as it might seem, is perhaps becoming more of a likely mechanism for kickstarting the economy once businesses are ready to invest and consumers are willing to spend. There are two ways to carry this out. The central bank can create money, give it to the governments to distribute, or give it directly to the private sector. You can distribute money to the private sector, give cash to all individuals in a country, for example, through an electronic transfer to everyone's bank account. The problem is not everybody's got a bank account, of course, and the government doesn't have access, thankfully, to all the bank account details. A more inclusive solution could be to transfer money to offset utility bills. Again, this still misses some individuals, and might be difficult in these days to get all the details from the private utility companies. But while helicopter money is a increasingly likely mechanism, timing is everything. And here I would agree with many that this is not the right time. The global economy has been deliberately put on ice until the virus is contained, at which point we can defrost the economy and hope that businesses and consumers go back to some semblance of normal, the new normal. It does not make sense to drop a massive stimulus while also telling everyone to stay at home, clearly. So first we need economies to open, confidence to return. Otherwise it doesn't matter how much money you drop. I'm still not going to go getting on a plane and go on holiday. So, but now is the right time to consider these theoretical, political, and practical challenges. So when the inevitable recovery does take hold, this mechanism may help. Now, of course, we are all familiar, certainly in the UK, with increasing blue skies. We've been blessed with great weather over the last few weeks and a very, very deep blue skies. So, which brings me back to, you know, the climate-sensitive recovery. An unexpected slant, perhaps, to the recovery is that climate challenge now is meaning that the post-pandemic recovery will be perhaps a decisive period for fending off climate change in the aftermath of COVID-19. Any number of factors could slow climate action, reduce political attention. For example, this year's UN Climate Summit, COP26, has been postponed to 2021. The easing or delay of environmental regulations in the interest of economic growth, depressed oil prices, make low carbon technologies less competitive, or stimulus programs that consume funds from governments that might otherwise have invested in a zero carbon transition. So targeted low carbon programs perhaps could restart growth and while ushering in a more environmentally sustainable next normal. I do think that low carbon stimulus spending can spur some economic recovery and job creation. In many countries, efforts to provide economic relief and restart growth after the pandemic are well underway. Governments around the world have devoted more than 10 trillion to economic stimulus measures. McKinsey, for example, estimate that just the G20 nations have announced fiscal measures averaging 11% of GDP. So 3 times the response rate that we saw in the 2008-2009 financial crisis. And some countries have said they will commit to up to 40% of GDP. So support is there, but are we seeing support mounting for a low carbon recovery? The informal Green Recovery Alliance, launched in April by 12 environmental ministers from the European countries, plus 79 members of the European Parliament, and 37 CEOs and business associations across Europe have been joined by more than 50 banking and insurance CEOs to persuade that we should consider this climate change related recovery. Top executives at upward 150 companies have signed a public statement calling for a net zero recovery. So the European Commission President and the German Chancellor have said that the European Green Deal should form the centre of Europe's economy recovery plan. And if I look at, I'll show you a graph here, populations around the world do favour recovery policies that also address climate change. So a very interesting view that people haven't forgotten climate change, despite all the tragedies around the world. So in this very burdensome time, what we often are guilty of is forgetting the less well-off throughout the world. And charity group Oxfam has warned that a recession caused by COVID-19 could push an extra 500 million people into poverty. So that's 8% of the world's population. Unless urgent action is taken, a survey conducted by King's College London and the Australian National University gauged that the short-term impact of containing the coronavirus on a global monetary poverty base of the world poverty line is around where we assume $1.93, $3.20, and $5.50 a day salaries, and then look at the impact they have based on new poverty thresholds. And if I share a screen here, we'll see that under all these scenarios, global poverty increases, but even under the best, under the $5.50 a day, you can see that there are a significant number of people impacted. The impact is set to be even worse in some hard-hit parts of the world, North Africa, Sub-Saharan Africa, Middle East, where literally up to 30 years of progress could be wiped out. The most serious scenario involves a 20% fall in income, which would, as this graph shows, suggest another 548 million people earning less than the World Bank poverty threshold of $5.50 a day. The United Nations has warned that 2.5 trillion is needed to support developing countries during the crisis, and that nearly half of all Africa's jobs could be lost. So the G20, the World Bank and the IMF are set to meet to discuss debt relief to poorer countries next week. Oxfam has urged them to agree to a global rescue package and mobilize the sums cited by the UN to avert a global economic collapse. Possible measures to raise the money could include the immediate cancellation of $1 trillion of debt. The IMF is doing a further $1 trillion in special drawing rights, SDRs, and an increase in flows to struggling countries. So much more to follow on that space, but something certainly not to forget. Coming back to the UK, well, we may be in an era where financial markets and all of us have been used to, or desensitized perhaps, to big percentages, but April's 15.2% decline in UK retail sales is nevertheless pretty much a shocking number. And I'll share with you some graphs here as I talk through this. It will come as no surprise that this is by far the worst monthly reading we've seen. In level terms, it means that sales were below where they were back in 2008, in 2009. All of this comes at an already precarious time for the British High Street. You know, the sharp fall in the value of the pound and the prolonged period of subdued consumer confidence following the 2016 Brexit referendum has hit demand over recent years, while retailers were contending with the combined cost pressures of consecutive increases in the minimum wage and more recently inventory building around Brexit deadlines. So while sales will receive a boost in June, assuming everything goes to plan and stores are able to reopen under the second phase of the government's COVID-19 plan, the road to recovery is clearly going to be tough. Social distancing requirements, I mean, for many businesses, operating profitably will remain challenging, particularly for those that are more resilient, less resilient and more focused on high volume, low margin models. Consumers appear reluctant to return to the high street, even after shops are able to reopen, if you look at surveys. A recent survey from YouGov showed that just under half of people would be uncomfortable returning to a clothing shop, although the jury is out whether the public will become more relaxed at the time retailers do open. Consumer caution is likely to accelerate challenges in the high street. Over the medium term, the turbulence in the jobs market means that consumers' confidence as well as spending power is likely to remain heavily subdued. There are growing concerns that these sectors hardest hit by the shutdowns, including retail, obviously, could see a rise in redundancies further down the line, depending on how the government's furlough scheme evolves. All of these factors are likely to accentuate the trend away from physical retail that has been going on for recent years. So online spending, unsurprisingly, saw an 18% jump upwards in April, taking the overall share of internet sales to 30% of the total, from 22% in March. And interestingly, the UK has already been further ahead in a shift to online spending compared to many other countries, which perhaps set up shop changes. Still, the bulk of shopping is nevertheless done in physical retail outlets. And when shops do open, in many cases, shops may not reopen. So moving ahead, and I wanted to talk a little bit about thinking about our holidays, and of course global tourism has suffered a crushing but while few industries have been spared the impact of the COVID-19 pandemic, fewer have been hit harder than the tourist sector. This is obviously has a direct link on many economies. And looking at Q1 of 2020, the World Tourism Organization says that the COVID-19 pandemic has caused a 22% fall in international tourist arrivals. So according to this agency, the crisis could lead to an annual decline of between 60 and 80%. This places millions of livelihoods at risk and threatens to roll back progress made in place in many developing countries. The United Nations envoy said that the world is facing an unprecedented health and economic crisis, but tourism has been hit hard, with millions of jobs at risk in one of the world's most labour-intensive sectors of the economy. So, and if I may, one more graph before we move on. Under these scenarios, the impact of the loss of demand of international travel could translate into anywhere between 850 million to 1.1 billion tourists loss, and a consequential impact of between 900 billion and 1.2 trillion in revenues from tourism. So this is by far the worst crisis that international tourism has faced since records began. The impact will be felt to varying degrees in the different global regions, and we would probably expect to see Asia and Pacific expected to rebound first. Unfortunately, the pandemic's impact on the tourism industry is expected to be devastating under all of these three scenarios I just referred to, although the opening of the borders and the gradual lifting of travel restrictions, assuming it begins in July, will still see this 58% drop. So prior to the coronavirus outbreak, the global tourism industry had seen almost uninterrupted growth for decades. Since 1980, the number of international arrivals skyrocketed from 277 million to nearly 1.5 billion last year. Experts do see a recovery in 2021. Domestic demand is obviously expected to recover faster than international demand. And the majority expect to see signs of recovery by the final quarter of 2020. But most of the recovery will be in 2021. Based on previous crises, leisure travel is expected to recover quickly, particularly visiting friends, relatives, etc., rather than business travel. And finally, before I sign off, Brexit. The prospect of a V-shaped recovery, as we talked about earlier today, is slightly fading as the country still searches for a breakout from the coronavirus, although the government is making progress every day. There is this equally pressing matter for retailers called Brexit. And the Brexit talks don't seem to be moving at the speed we would hope. And as ING's James Smith, economist, explained, that given all this, we really don't expect the British economy to return to pre-crisis levels until 2022. So a lot to take in, not all good. I think we're seeing some stability coming in, and the lockdown measures of the government, unlocking measures rather, the government is bringing in, will hopefully start that recovery. But a lot more to go, and thank you very much for listening. I'm Mark Jarvis, and thank you once again for listening.